Hey, everybody. This is Harlen, and I'm going to be helping you get started with investing today on the Lazy Paddler Investing Show. All right. So, I just recorded a version of this, and it was way too long. So, I'm going to cut this down a lot. I'm going to give you some basics here. And if you have questions, leave them down in the comments, and we'll address those on future shows. So this is an explanation of what I would do if I was getting started investing right now with the experience that I already have, but if I was starting from scratch. Okay, cool. So, first step I would take, I would get an account. And again, since it's me, I would probably get an account with someone who could do fractional share purchases because I love fractional share purchases. I think they're fantastic, especially if you're young or you don't have a lot in a particular account that you want to deal with. Let's say you want to diversify what you want to buy and you want to buy 30 or 50 companies, but you only have like maybe $500, maybe $100, right? If you want to buy $2 worth of every company on your list and you have 50 companies, that's $100 right there. But if you were investing that through a standard broker in a normal brokerage house, old school style, you would have to spend the full share price. And a lot of companies' full share prices are over $100. So you might only be able to buy, if you had $100, one share, if you were lucky. Forget about buying something like Amazon that at one point had a share price at the $2,000, $3,000 range. I don't even know where they all are today. Anyway, fractional share purchases are your friend, especially when you're getting started investing. Also, if you kind of don't know what you're doing, it's fantastic, right? Because you can use diversification to help keep your risk low for any particular company, right? So if a company's stock is very expensive and you're like, oh, I want to try it, I want to buy it, but it's a lot, but I'm going to get in there anyway and take it, and I'm going to buy less of other things. Well, then it can kind of force you to spend more than you want to, right? Fractional share purchases allow you to say, all right, I'm going to create basically my own mutual fund. I'm going to have like, maybe I'm going to invest $1,000 total, and then I'm going to invest 10% of it in each of these 10 companies. So you're investing $100 in each. It doesn't matter what the share price is. Cool. So I believe some of the companies that will allow you to do fractional share purchases are things like Robinhood, and I think Public also does it. I am not entirely sure, but I think so. I was reading that TD Ameritrade allowed that, but I don't know if they actually do. So I would say research it, find out if the company does allow fractional share purchases. Also figure out how to get your account set up. It doesn't take very long these days. Almost always it can be done online. If it was me, I would be doing an online brokerage only. I would not use someone to help me. I would not use a sort of phone broker kind of situation. They're very expensive, in my opinion, and I would not go down that road. Next thing I would do is I would start triggering savings. So whenever I got paid, I would take money out of my paycheck. So it's easier if you have a salary and you know exactly how much money you're going to make every 2 weeks or every month or something like that, right? And so you trigger that to be pulled out. So you link your brokerage account to your checking account where you get your automatic deposit, right? And then you pull that money out. I highly recommend getting all this stuff set up automatically. Get direct deposit for your paycheck. If your employer doesn't set something like this up, you have to, mechanically actually take a check and, you know, deposit it. Uh, Try to make that as easy for yourself as possible. And then once your money is in there, if it was me again, I would set up a automated system to bring out a percentage of that, something that I know is going to come out. So I would calculate that percentage in advance, and I would say, all right, if you know, say I want to take out $100 from every paycheck and move it over into my brokerage account, and I would do that every 2 weeks. I would set up those rules in my brokerage, and I would have that pulled out automatically. Also, if your brokerage allows you to do automated buys, I would set that up as well, right? Because if the money is coming out, it doesn't make sense to sit there in cash unless you're the kind of person who really likes making manual buys every month. If you really like making manual buys every month, you might not want to have that automatically done, but it can be also fun to, do it that way. So it's up to you, obviously. But if it was me, I would have it set automatically, and then I would change it whenever I kind of was like, oh, I want to add something new or remove something from this. I might change how I'm working with those buys. And then I would say, regardless of what you're doing, invest regularly, invest over time, invest while you're young. I would it, again, it's different for every person. And investing for you might mean something slightly different. It might mean paying off your credit card bills, right? But building for your future is going to be really important. If you can't build for the future, then chances are something is wrong with the way you're spending your money, right? You don't have enough income coming in for how much money you're spending, or you have too much debt load or something like that, right? So you have to rejigger. You have to figure out, can I get a job that pays more? Do I need to go back to school to do that? All these kinds of things. But regardless, investing regularly is your sort of ticket. It was my ticket to kind of becoming financially free later in life. So time is your advantage. So the younger you can start doing this, the better it is. Now, there are all kinds of different investment accounts you can choose from. You may have an employer-sponsored account like a 401k or a 403b. You may also have like a simple IRA or an SEP IRA. You may have a IRA of your own that you set up, right? It may be associated with an employer, it may not. Some of these things are walled gardens. I don't like walled gardens. I was stuck behind a walled garden for a long time with my money at my former employer, and so was my wife at her former employer as well. So our money was restricted. We could only buy the things that they offered us to buy. I didn't like that. There are some advantages to being in those accounts because you can buy and sell things tax free as long as you're not taking the money out. But there are a lot of things people don't understand about those accounts. I'm not saying not to do them, especially since a lot of times companies will add their like 4, 5, 6% matches to your money if you're in those 401k accounts, for example. Don't leave that money on the table. Get that money. But once you've gotten the money, seriously consider other pathways for saving and investing. Having an investment account of your own maybe it's an IRA, maybe it's not, can provide you with a lot of advantages. And keep an eye on things like capital gains taxes, for example. The interesting thing about capital gains taxes is that they're actually not that bad. They're actually fairly low. So when you are investing, as long as you're not buying and selling that often, you can actually let your money grow tax free as long as you're not selling. So think about how you plan on taking the money out later on. Think about diversifying how you're storing your money so it's not all in one place and you're not uh, focused on only retiring in one particular way, or I'm only going to get this money out if this or that happens, right? Think about various different things that might come up for you. How might you need to get to that money if it's 5 years, 10 years, 15 years down the road? Will you be old enough to take it out without a penalty? You may not be, right? So you may want to have some money in an account that's heavily tax advantaged and some that's not, so that you can do things like put a down payment on a home, pay for medical care that's a surprise, buy an automobile, all kinds of stuff, right? That you might need to do. So don't think about this in terms of just having one account. Think about it in terms of what you might use that money for later. So once you've got an account, what are you going to do? What are you going to buy? I could tell you all kinds of companies that I would love to pick up right now. Uh, but that's not the point. I'm sure you have a lot that you would like to, or maybe you don't. Maybe you have no idea. There's something for everybody out there. So when I was getting started, the thing I did at first was invest in mutual funds. And I didn't understand how expensive they were. Today we have things called low cost, or generally they're low cost index tracking funds. They're automated. They follow publicized indexes like the S&P 500 or the NASDAQ 100 or whatever. Because they're automated, it doesn't cost them money to have a person managing it, really. They just have a programmer set it up. Once it's set up, it runs itself. Cool, right? So they're able to charge less and less money for it. So you can find low cost index funds, and those low cost index funds can help you track the general market. It's a fantastic way to invest. Generally, there are studies that have been done that show that our professional investment advisors tend to underperform the market. Because you can actually invest in a market tracking fund, it doesn't therefore make sense to try to find out, like, is my mutual fund that's managed by a human being actually going to beat the market this year? If you don't care that much, right? Buy a market tracking fund. It makes a lot of sense, right? So you can meet the market where it is. Now you're not going to outperform, obviously. And it's not super conservative either. Markets can do well over long periods of time, but you can go 10 years without really increasing your value. It happens, right? So you're investing in the market, and you need to take care, and you need to sort of build up over time. But that said, if you're the kind of person who's making money and buying as you go along, markets bounce up and down and they do things. And there's a thing called dollar cash averaging. It's a fancy way of saying, if I buy every couple weeks, Sometimes it's going to be low, sometimes it's going to be high. But if I put $100 into the market every time I make those buys, sometimes I'm going to be buying less stock. Sometimes I'm going to be buying more stock for that money. Sometimes I'll be getting a bargain. Sometimes I won't. But the beauty of it is you don't have to really think as much about timing of the market. It's extraordinarily difficult to time the market. This is why uh, a lot of times people will say, "Oh my gosh, some so and so predicted the downfall of this stock or that stock, and they got it right." Well, it's big news usually because it's basically one of those situations where the broken clock is right twice a day. So they celebrate that, but it's not always wisdom that they're celebrating. A lot of times it's that broken clock concept. You can be able to avoid stuff like that by dollar cash averaging, right? So if a stock that you like plunges 30% in a day, as happened to me recently, right? If you're buying on a regular basis, the next time you make a buy, well, you're going to be buying that stock at a discount. And especially if you're younger and you're looking at a 20, 30, 50-year time horizon for your money, that's extraordinarily helpful, right? So you can basically average out, this is why they call it dollar cash averaging. You can average out your expense on those things. And so what I like to do when I was getting started was I started out with these mutual funds, and then I was like, too expensive. I'm going to toss those. I'm going to get index funds instead. So I put my money into an index fund, and then I was like, okay, I'm going to learn about common stocks. I'm going to learn about companies. And so I would take a little bit of money out of that large chunk that I had saved, and I would say, all right, I'm going to buy this stock, that stock. And I started adding individual stocks into my portfolio. As I did that, I started to have the ability to really sink my teeth and into those companies, really understand what they were about. And I started to understand the kind of things I cared about and the kinds of things I didn't. What kind of companies I was willing to follow, which kind of companies I wasn't. What kind of companies I understood and which kind of companies I really didn't get. Like, I'm horrible at investing in fashion. Fashion is not my thing, as you can tell by my extraordinarily fashionable blanket shirt. I don't care that much, and so when I would buy, it would be because, oh, I read about it, I saw the company, I kind of liked it. Maybe some other investors that I respected were in that company, and I was like, all right, let's try it. It didn't work out for me. But there were other things that I was really good at, like entertainment, technology. These were areas where I worked and where I enjoyed participating as a fan, right? And so it was much easier for me to understand what those companies were about, what they did, how they made money, and I could really understand the customer in those situations, right? So I could really understand a customer who would use a particular kind of product, maybe a programmer who's using a particular kind of product, maybe a security expert who's using something, or maybe someone who likes to watch films or go to concerts or things like that. I got it. I understood those things a lot better than like someone who's going to go buy handbags or clothes or something like that, or surf gear. I just didn't get it, which is cool, right? So you can find these things for yourself as you build out those pieces. And a lot of people will say things like, look, if you're going to invest in common stocks, you need to have a diversified portfolio. This method of building up a diversified portfolio by starting with one or two can get you there, all the while you're anchored in a very, very well diversified mechanical portfolio, which is an index fund, right? So an index fund is usually a large group of stocks that track something, again, like the S&P 500 or the NASDAQ 100 or the Russell indexes of various numbers. And it just has a ton of stocks in it. Even the NASDAQ 100 has about 100, it's a little less, but about 100 stocks in it already. NASDAQ 500 has approaching 500 stocks in it. So when you buy that, you're already diversified that much. When you start buying your individual stocks, what you're doing is you're increasing your concentration. You're saying, I'm going to bet more on this particular one. And then over time, you can shrink the amount of money you have in your index fund, which is what I did, right? And then eventually you might decide, look, my returns that I've been getting on my self-managed portfolio are good enough. I'm confident enough. And then you can just say, look, I'm just going to reallocate all this stuff to the companies that I own either today, or I'm going to make some buys off of that are new things. And I'm just going to, shut off that and move to the other. This is a fantastic way to learn while maintaining diversification, while also managing your risk, right? I highly recommend it. I also highly recommend you do this in an automated fashion. So if your system will allow you to make a buy of a couple of dollars a day, or not a day, a couple of dollars every time you get your paycheck in particular companies that you want, and you can allocate like 5 or 10 or 20 companies to do that, and it's automated, and you're like, I spend a little time, I get it set up, and I just set it on autopilot. I don't worry about it. That is a fantastic way to get your diversification, maintain discipline, have fun by, choosing the companies that you want, and match your own ethical profile, right? So if you're buying, for example, the S&P 500, I don't think anyone's going to be surprised to see that ExxonMobil is going to be in there, right? All these oil companies are going to be in there. Coal producers are going to be in there. There's going to be arms manufacturers in there. And there may be a lot of things that you disagree with, is my point. And so if you are buying individual stocks, you have the ability to buy things that match your ethical profile, things that match your preferences on what you are willing to do research on, and things that give you a sense of fulfillment when you are doing your research and when you say, hey, I own this company, right? Most people aren't proud to say, I own the NASDAQ 100. Because most people don't know what's in it. What they really are owning are the major components, right? Like Apple and Intel and stuff like that. I think Intel's in there. Oh, actually, I don't know. Amazon, Apple, Netflix, those kinds of things are in there. Again, I'm not recommending you buy particular stocks or funds, but I am saying that those index tracking funds, they're cheap. You can find them with very, very low fees. They track things that are well known. They track things that are very difficult to beat, right? And so when people say, did you beat the market? Well, these things are tracking to the market. So you can be fairly certain with most of the larger ones that they're going to be able to do that. And then you can diversify out when you want to. That's how I would set it up if I was me coming in and starting anew today. And I was like, okay, I don't know yet how to really invest in companies. I don't have a good handle on understanding what a lot of companies do. I know how to invest, but I don't know the companies that I want to invest in. I don't know what I'm good at yet, right? Like that's where I'm trying to trying to get people right now. I'm trying to get you to a place where you're able to start learning and becoming confident in these companies that you're investing in. I highly recommend paying particular attention to what kind of account you're getting, reading up on the tax issues, figuring out what the gives and takes are, right? Be aware of tax penalties, but also remember, you know, when you buy and hold long term, a lot of times you're protected from those things. Allocate your money out, buy a broad diversity of companies, especially if you're new to this. I would say 30 companies probably. If you were just going to invest in individual companies, I would say 30 at least. If you're a more advanced investor, you might want to tighten that up. But I know of other investors that actually broaden it. They actually have a lot. It's just they might have concentrations, right? So I actually probably invest in over 60 or 70 stocks, but I have high concentrations in some that I believe in a lot. They've earned their place in my portfolio. They have grown substantially, and I kind of just left them. Okay. I think I covered everything I wanted to cover. So if you have any questions about particulars about this or any other investing concepts, go ahead and leave questions down below. I'm happy to assist folks with content around this. I'm I'm looking forward to filling out a little bit more investing specific content on this channel. So whatever you're interested in, let me know. The things that are most commonly asked are probably the ones that I'm going to try to address the most closely. All right. So as always, take care when you're investing. Remember, you can lose money when you're investing. So do your research. Don't just buy things because it starts with the letter B, or you like the ticker symbol and it's funny. Like, learn about the companies that you're investing in. Find an investing philosophy that is logical and makes sense to you, and follow it well. And invest for the long term. That's your edge as a retail investor. Invest for the long term. All right. Thank you, everybody. Have a wonderful day.